private clients or private companies have started to see, especially developers or large commercial projects, they want bonds now as well because they see the benefit here. Because when it comes to most jobs, the real cost is not the dispute. It's not the amount that it's going to cost you to actually do the project, but rather a massive cost is any of that delay. So if you're building, say, for example, a large commercial project, having a 1 year delay is going to cost you way more than that, the cost of the bond, right? So that's why we see a lot of private guys going in and saying, hey, here are my financials and here's how I make this work. Here's, how I can, do this project, be profitable. So they get bonded so that they guarantee that they don't get this 3 month, 6 month, 9 month delay.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Gary Eastman. Gary is an attorney turned entrepreneur who has built a thriving national surety bond brokerage business into one of the most misunderstood sectors of finance, or in one of the most misunderstood sectors of finance. And in just a minute, we're going to speak with Gary about performance bonding, also known as surety bonding. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Gary Eastman. Welcome to CREPN Radio.
Thank you so much for having us on today. I really appreciate it.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
No, absolutely. So as you mentioned early on, I am an attorney by trade. So went to law school, started practicing, the big AmLaw 100, then went in-house to do some general counsel at some big public companies. And then I said, you know what? I started practicing just with people because I was doing too many big files. So I started doing some, estate planning and probate work. Well, in probate, you need probate bonds, which led me into starting to provide bonds for, my clients. And then I said, well, if I'm providing bonds for my clients, I can provide them for other attorneys that need them. Started doing that. And I thought then, once I actually had this infrastructure built, I started doing additional bonds for, contractors. And that's really where this brought us to today. Started off as an attorney doing court bonds, and now we do, really, surety bonds for, tons and tons of construction companies across the U.S.
Cool. So, as far as bonds go, and you mentioned the probate and the surety bonds, maybe a good place to start is just, what is a bond? How is it different from other financial instruments?
Absolutely. That's a great question. So what a bond is a three-party contract between the obligor, the obligee, and the surety. Let me explain what those terms are because nobody knows what they are. So let's take an example. Let's say you're a general contractor. You're going to go out, you're going to build a school. So you're the obligor, which means that you're the one that's going to build the school according to the terms of the contract. Then the obligee is the school, right? Because they want to make sure that the work gets done on time. And then the surety is the party that is guaranteeing that. Now, the real question is, what's the difference here between a guarantee and a surety bond? Well, a surety bond is a three-party contract. And what that means is that the obligee, in this case, the school, if there's a dispute, they can go directly to the surety to make that whole, to get that project done on time, make sure all the material vendors are paid, make sure all the subs are paid. They don't have to go through the court process to therefore, get a judgment. So therefore the guarantor has to pay. They get to bypass that. And so the reason these are so important, one, from federal projects, over 125,000 are required under the Miller Act. But really the key is if you have a project like a school or a road, you can't afford to have a 2-year delay while you're going through a dispute. So you use a surety bond to make sure that gets done. I think that's also why some of your clients, in the commercial real estate have really started to lean towards bonds as well.
Yeah. No, and as far as the contract itself, so you have the obligor and the obligee. The obligor is the one doing the work. The obligee is the one that's imposing the requirement, right, on the
Correct.
obligor. Um, my I guess follow up to that would be just as a distinction because I think people sometimes until they've touched fire or been through the process or understand fully how things work, it's just a word. And so the like you said, the obligee has the opportunity to go direct to the surety and shortcut the getting the funds needed to finish their project or whatever, or to be able to finish their project. But within the bond, can you talk a little bit about the agreement between the obligor and the surety company, how
Mhm.
they see things?
Okay. Yeah. So let me start with the beginning of the initial question is how is a surety bond different than insurance, right? Because this
Right.
is kind of key here because people tend to think of them as insurance and it's not. So insurance at its very fundamental is a risk sharing, right? So, hey, 1,000 of us get a insurance policy. We know that somebody's going to have a fire, but we don't know who, right? So we're just sharing that risk. Surety bonds are not written that way. They are a zero assumed risk contract. So surety companies, when they underwrite a contractor, they're not going to assume any risk. But what they do is they're going to take a look at a couple things to underwrite that, the obligor. They're going to take a look at their financials, right, to make sure that they're financially strong, they have good character, and then they'll also take a look at the contract itself to see what terms are in the contract. Because what they're guaranteeing is really two things: that the contractor or obligor will live up to the terms of that contract. So they want to make sure the obligor can, and then of course they want to make sure that the contract is something they can live with. Uh, and so where this comes into play is, if the obligor, that contractor, can't do it, then they need to find a replacement. So you just can't have something in that contract that only one person can do. That makes it impossible, right? Or terms that just make it so expensive that if they fall down, like a liquidated damages clause that is so high. So they're going to take a look at both of those things to provide that underwriting.
Got it. Got it. And so the bond, so we understand the parties that are the three parties involved. We understand kind of the viewpoint from the underwriting, the underwriter, the surety bond company, how they're looking at it. And then I guess the next thing I would ask is how, so the contract between the surety and the obligor. So if that obligee or obligee, is it G or G? Either way,
It
come
goes
see, come
both
saw.
ways.
Okay, all right. If the obligee makes a claim to the surety and collects, what they get paid? What's the relationship, or how does the contract work, and what happens then after if the surety pays out? What happens?
Okay, yeah. Actually, let me walk through the claim
Okay.
process a
Yeah,
little bit to
yeah,
help.
yeah.
So let's assume that the obligee makes a claim saying, "Hey, the obligor has messed something up, or didn't get it done, or didn't pay somebody." So the first thing the surety does is they actually, go through the claims process. Is it valid? And so there's two options to the surety. One, they could pay damages, the amount of the bond, or two, they can hire somebody else to come in and complete the project. So from the obligee's perspective, right, if somebody comes out and finishes the project in time, then they're done. They get a walk away, right? The surety will basically absorb those additional costs, right? And then they'll go back to the original obligor saying, pay us back. If they can, right? Many times they're defunct at that point. Or they could pay damages to the obligee, at which point then they go back to the obligor saying, pay us back. So they have both options available to them. Normally, they like to finish the project because they just want to make sure that the stuff gets done, because that's the key. That's the whole reason for that bond. It's not to have it sit out there and have, so they get a replacement contractors or, businesses to come in and get that done as fast as possible.
Got it. But the underwriting, or I guess the key there that I've had conversations with obligors that didn't fully understand is that the indemnity agreement, the contract they're signing with the surety says if they pay, you're going to pay. So it's not just a walk away. I mean, you're in it. And that's why the underwriting. Can you explain a little bit of the and you touched on it, but if you can kind of touch a little bit more on kind of what the surety is looking for and how if there's any kind of math multiples on what if somebody has a need for a bond, what kind of limits or the limit to what their ability or their capital on hand or that kind of those ratios. If you can talk about that, that'd be great.
Absolutely. So let me walk you through. You're absolutely right. Like the contractor, when they sign that indemnity, it's both for the company and them personally, including any spouse, right? Because what they don't want to do is have assets go to the spouse, and if the spouse isn't covered, sureties had that happen years ago. They've caught up to that game, so that's out. So yes, they'll go after the contract, but that's also why they underwrite so strictly, right? I like to refer to sureties as conservative bankers. So here's how this works. Up to, let's say, $700,000 to $1 million, a lot of those companies now, or at least several companies now, have what they call credit-based programs. That simply means that if you have a very high credit score, think 750 or above, you can get qualified for that if you've done jobs of that size. But then after that, they're going to ask for financial statements up to about $1.5 million, $2 million. These can be internal statements, P&Ls, balance sheets, personal financial statements. What the sureties are looking for is a financial profile that is solid. So typically it's at least 10% of what we call working capital, if it's a working capital type of job, right? So yeah, do you have 10% there? The second thing they tend to look at is, okay, if the obligee doesn't pay for 60 days, will that put you under? Many times for some people it will, if they're too stretched out based upon, the amount of receivables they have outstanding. So they're going to take kind of a deep dive and take a look at, hey, do you have enough of a financial wherewithal, not only to do the job, but also handle any bumps in the road? Over $2 million, they're going to typically require financial statements that have been reviewed by CPAs, which provide, more assurance. They also then take a look at work in progress, ARAP schedules, just a lot of a deep dive into, hey, can you do this? What are the issues? What are the risk issues? Does it match the contracts that are coming up? And then of course those financials have to be updated, periodically as more and more jobs are done. So the answer is depends on the tier where you're at, but the underwriter is definitely going to dig in.
Got it. And then you mentioned kind of the lower limit bond where it's more of a credit. They look at your credit, individual credit to determine, it's your ability to pay is what they're looking at there. And then you mentioned the financials reviewed as opposed to, I think, what are most compiled and reviewed and then audited? Is that the different levels of? So
that's okay. Right. Yeah. So for CPAs, they'll compile, which basically means they put them together. Right. Reviewed means they put them together, but a second CPA takes a look at it to make sure that it makes sense. Audited is actually where they come in and actually, dig into you themselves. For most bonds under $10 million, we don't need audited financials. Once you get over that amount, then typically, audited is going to be a requirement.
Got it. And just the if you could explain a little bit about kind of the um, I guess kind of the relationship between an uh, obligor and a surety company, because I think one of the things I've found is that people assume that just because they have the opportunity to do some work, all of a sudden now they need a bond, that they should be able to get the bond, uh, versus the reality of it's kind of a long-term relationship with a surety company. Can you talk a little bit about that, where how you see people or obligors kind of progress through the life cycle of bonding?
Absolutely. It's a great question. So a lot of obligors, when they start out, they just think it's a piece of paper, and it is not. It's really a relationship. And so we try to do with our clients is we provide them a lot of, education on here's where you're at, here's where you can go. Because what we want to do is build up not only, all this stuff that helps them out, including things like, hey, in your financial statements, instead of taking everything out and having the lowest tax thing possible, leave some money in the business so you have higher working capital, higher tangible net worth, so that the sureties will provide you with larger and larger bond limits. Because usually it's bond limits that make sense. You also are building that relationship with that surety, so that they have seen, hey, you handle all your jobs. We don't have any issues. We're willing to expand that bond line larger and larger. The reason the larger bond lines make a lot of sense for people, is that competition goes down farther and farther and farther, as you would expect, once the jobs become bigger because fewer people have those bond lines. So margins also, in the bond world are nice to start with, get larger and larger. And so all of that plays together to make you a stronger company, get you a better relationship, continue to build your business in a way that's better. So what we try to do is we try to keep those clients from just thinking of these as one-offs, but rather the start of a relationship to expand that bond line. Bring your rate down a little bit, of course, but really it's those jobs that you can go after, build up your expertise in those jobs, not only from the bidding to working to closing them out, getting retainage in, continuing to build all of that together. And most of our contractors, 3 to 4 or 5 years in, really start to compound all of that and are really starting to do very, very well.
Right. And I wonder if you could just kind of walk through kind of the life of a bond, from the, because, and let's back up here one second. Are most of the jobs that kind of drive bonding public works? I mean, from where the need starts, but now you mentioned like some of these commercial real estate developers are saying, well, wait a minute, we want that. Is that a fair description, or?
Yeah, absolutely. So bonds originated, with federal jobs under the Miller Act. And then, of course, states jumped on the bandwagon saying, hey, this is a great idea. Let's do that. So that's the kind of the genesis of most jobs, federal work that's fairly large. What private clients or private companies have started to see, especially developers or large commercial projects, they want bonds now as well because they see the benefit here. Because when it comes to, most jobs, the real cost is not the dispute. It's not the amount that it's going to cost you to, actually do the project, but rather a massive cost is any of that delay. So if you're building, the say, for example, a large commercial project, having a 1 year delay is going to cost you way more than that, the cost of the bond, right? So that's why we see a lot of private guys going in and saying, hey, here are my financials and here's how I make this work. Here's, how I can, do this project, be profitable. So they get bonded so that they guarantee that they don't get this 3 month, 6 month, 9 month delay. Now we see a lot of other guys going in is like, I just, I don't need a bond. I don't want to spend that, 1, 2%. I'm really going to just, get on my contractor. And then they find that the contractor delays them because they're doing something else. Then they have this fight and this dispute. Suddenly they're 6, 9, 12 months down the road, and they find out, uh-oh, this has really cost me. Now, There are some guys that do this that are like, a delay is a delay. It's not that big a deal. But for most people, they're like, it's 9 months of delay is way more costly than anything else. And that's why we see people building it into their financials saying, hey, here's how I can get my project up and running. Here's how I can get clients in the door. And that construction risk, I would just call it, gets kind of pushed to the side. Did I explain it okay?
Yeah, yeah, yeah. No, and then I was going to ask, let's talk a little bit about the cost of a bond. Um, can you give kind of a ballpark, kind of a range of what one can expect if they're, um, I guess if you're uh, an obligee and you're requesting, I'm assuming that the obligor, I've never seen an obligor just assume that cost. They're going to pass that on to the obligee. So round numbers, I mean, talk a little bit about the cost and how the cost can vary amongst obligors and how that kind of helps determine the level of the contractor that you're working with.
Yep, absolutely. Yeah, so for those credit-based programs I talked about earlier, where they're just going off the credit score, the typical cost is 3%. That's the standard across the industry. Once you start moving up in job size, then the cost goes down. It's usually going to be between 1% and 3%. And that 1 to 3% is going to be based upon a couple of factors. One, how strong that client is, right? The obligor, are they really strong, fundamentally? Two, the type of project always makes sense. And then three, any other risk factors that they see, and including timeline and warranties and all this other stuff that gets built into the contract. So for really large jobs or contractors that do tons and tons of stuff, think like paving guys, the cost will be below 1% typically. So for most clients, the 1 to 3% is a good range, depending on the size of the job. If it's, if they're smaller jobs, 3% is the standard. Everybody builds that into their contract price. So when you require a bond, you have to expect as the obligee, you're going to basically be absorbing that. Now, when it's a competitive bid process, obviously people are coming in to try to compress their bids just to win the work, but all of them will build in that 3%. So there's a little interplay here of, compression because they're bidding, because it's competitive, while, you get a 3% expansion because everybody has to have the bond.
Right. And so if you're the obligee and you have a project, so you're going to build an apartment complex and you've got, a general contractor, you're looking at a couple different generals and, part of your requirement is that they provide proof that they can be bonded. Can you talk a little bit about that and how, what that is, and then that in relation to their capacity, kind of thing, and understanding just you know, the 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 ability for this one job is one thing, but it's not how it relates to the whole, their ability to be bonded for more. If you can
Yep.
talk a little bit about that.
Yeah, it's a great question. So yeah, so the first thing you want to ask, hey, General, do you have a bond line? That's important because there's a third party out there that's fairly conservative that says, hey, we do we're willing to stand behind this contractor and provide guarantee that they're going to do their work. So just getting that, what they call either a bondability letter or a good guy letter, is important. So that just says, hey, somebody has taken a look at this and they do believe in this company. And so that can help you differentiate who you're going to go with. The second part is what you just talked about is, what's your capacity? And what that tells you as an owner is, hey, company A may have twice as much capacity. What that means is that they're, the surety has taken a look and said, we really think these guys are strong. We like their working capital position. We like their tangible net worth. We like their history. And so because of all of that, we're willing to provide them with more and more capacity because we believe that they can do a lot of different things at one time because they have the infrastructure, they've got the character, they've got the financials. Another company, maybe just strong financially, but may have less history, so they're not quite as assured. And so that's just things to take into consideration here. Neither's right or wrong, right? It's just a tool for, clients to use to say, hey, I like one, and maybe this will push me over the edge for them.
Got it. And with larger projects, um, is it common for one bond from the general, or do you also see situations where like some of the subs will bond back to the general, or can you talk a little bit about that? Or
Yeah, so from the obligee's perspective, they're going to get one bond. That'll be
okay,
the general to the obligee.
got it.
However, general contractors to help them get that increased bond line you're just talking about, sureties will go back and say, I want you to have your subs, at least the larger subs, bond back. What that means is the sub is going to go get their own bond that guarantees the subs work. And so sureties use that as a tool to, have a contractor that, let's say, would normally qualify for, let's say, 10 million aggregate. They'll say, look, if you get your subs to bond back, we'll go all the way to 25 aggregate. That just allows them to do more work because now they're guaranteed that the subs aren't going to collapse. It also, it's really a risk mitigation tool because what you're doing is you're saying, hey, all these other guys are going to be involved. Now I don't have to worry about them in the same.
Got it. So with respects to like commercial real estate development, um, is there a limit where you see or a deal size or a project size where you see the bonding more common? Because I'm assuming like a smaller project is just not it's not as prevalent, but in more of a larger project, is there a project size where you see bonding kind of come into play?
Yeah, so we're seeing that limit continue to go down, right?
Yeah.
So, 5, 10 years ago would be at the 5 million and up range. We're seeing that down kind of at the 2 million and up range now. Again, mostly because it's that delay piece as people are going in. Back when we had 0%, super, super low rates, people had a little bit more margin of error. Now that the rates are a little bit higher, we're seeing people saying, hey, I really need to get clients in here for whatever this is, whether it's a office space or, a lot of commercial we're seeing today are like for, contractors, plumbers, HVAC folks, more of the, uh, I'm going to call trades, stuff that's made specifically for them, because they want to make sure that those guys have a landing spot. They can, get in and start collecting rents on that stuff. So we see more of those, getting smaller over time. So $2 million seems to be a good breaking point. I've seen them lower than that, but in general, that tends to be where we're seeing the financials shake out today.
Got it. That makes sense. Um, do you have any kind of unique bond situations you can tell about, or any kind of stories?
Oh,
Just
bond stories are never that exciting. um, See weird bonds. And so, we've talked about contract bonds and different places, like different locations, you'll get ones in like Guam and all these weird spots but we also have, license bonds that we see. So we now have clients that'll come in that need bonds for cannabis, right? Not something that I normally would think about. These other, there are between 25 and 35,000 different types of license and permit bonds. And that's a terrible stat to throw out there that says, hey, the industry only can estimate how many bonds are out there because nobody knows. That's probably the craziest stat in the world is that we're all estimating how many bonds are actually existing, different types of bonds, because nobody's figured it out yet.
yeah. No, it's definitely a unique product, and definitely some of the ones we've talked about are kind of more the standard. But I've seen clients ask about, could I get a bond for this? And there's depending on the dollars involved and how creative the underwriter is. I've seen some underwriters be willing to do things that perhaps otherwise wouldn't have thought possible. Um, what about like just for a contractor? Uh, Say somebody's had some credit challenges in the past. Do you have the ability to kind of work with somebody that's trying to get back on track, or is there do you have kind of a pretty wide appetite as far as underwriting goes
Yeah,
for
so
credit?
yeah, it's a great question. And so we've developed a path for those people that have struggled in the past. And so typically there's a couple different, we like to use a provider that likes to use the SBA for a guarantee. So the SBA for a fee, will come in and guarantee a big portion of the bond. That allows you to underwrite some of these folks. There are additional tools that you can use like escrow so that money doesn't go directly to the contractor, but goes to this third party company that will then pay everybody out. That, eliminates basically payment risk. And then of course, you can always use something called collateral where they actually put up dollars to guarantee that we try not to do that because, you know, that could tank the business together.
Yeah.
There's that path. And then that path, gets you from, starting back again to getting that. What we try to do is get it released in stages, get rid of escrow first, then get rid of SBA, and then grow that so that you can then get back into the normal things, expand that bond line.
Got it. Got it. Well, hey, if we could, I'd like to shift gears here for a second. As we've talked before we started recording, by day I'm an insurance broker. And as such, I work with clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. First, we look to see if there's a way we can avoid the risk. If that's not an option, we look to see if there's a way we can minimize the risk. And if we can't avoid nor minimize, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, bond market, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Gary Eastman, what is the biggest risk?
Okay. So this is a great question. And I think there are two risks that kind of embed themselves in everything that we see today, at least from the surety bond perspective. One, financing risk, right? Because those are, the amount of capital available is going down. If the cost of capital is going up. And then the second part is labor. We're short of labor, and so we're going to continue to be short of labor. So those two things are an interplay all the time. And so we see, bonds being able to help minimize that risk. Both of those risks. And so if you're a real estate developer, right, your financing risk is set, again, it's set up in how we do it. So you get the bond so that you can make sure that the project's done. You can get clients, into the space and start receiving, some sort of return on that. The second part, of course, is labor. You don't want to hire somebody who then turns around and, all their subs have disappeared or they're doing something else. And so bonds have, given you a way to basically minimize both of those risks. We see that in every part of society now, and places where we didn't see it 5 years ago. So bonds is a tool, not the only tool that you can use to go out there and start minimizing that risk, mitigating that risk before it happens. And then, of course, the other thing is if there is a problem, we like to jump on those quickly to mitigate the risks down so that we don't have massive lawsuits and problems going out there. I've been doing this since 2008, and I have been fortunate that none of my clients have been involved in a protracted litigation, which as an attorney warms my heart. But those are the things that we see all the time that we're trying to eliminate if possible, and then mitigate when they do occur.
Got it. Got it. Gary, where can the listeners go if they'd like to learn more or connect with you?
Absolutely. They can look at our website, swiftbonds.com or access-surety.com. We're also on YouTube and all of the other famous social channels.
Got it. Well, Gary Eastman, I can't say thanks enough for taking the time to talk. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Hey, it has been my pleasure. Thank you so much for having us on.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.